welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. I'm a little froggy today, sorry, I've got a little bit of a cold. We're charging ahead. My guest today is Craig Martin. Craig is a certified financial planner. We've known each other for many years. His company is the Family Wealth Consulting Group. They are fee-only financial planners. He's been doing that for about 33 years. Craig wrote a book called Asset Class Investing, and I'll bet if you contacted Craig, he would be glad to send you a copy, and his wife would be even more glad that he sent you a copy. So anyway, Craig, thanks for joining me today.
Yeah, happy to. You are recording some of the best financial people in the Valley on your show. I'm real glad to be a part of that. But you need to be commended for recording for posterity the great minds in the community today. You've had some very great people on your show.
Thank you for that, Craig. Yeah, I'm pretty excited about it, that I've been able to do that.
Yeah.
Anyway, Craig and I today are going to be talking about the role of emotions when investing. And it seems like in so many areas of life, we are often our own worst enemies. And so quite often, although people don't, if you talk to analysts, they don't seem to get into this area of emotions so much. Actually, we think that it's a pretty important area. Craig, I understand actually that a Nobel Prize in economics was awarded a few years ago relating to the role of emotions investing. Maybe you could comment on that for a few minutes.
Oh yeah, I'd be happy to, Mike. Professor Kahneman won the Nobel Prize some 10, 12 years ago for what we call now behavioral finance. The interesting part about what he wrote was why we think the way we do, not necessarily what. And we're able to map the brain now to find out what parts of the brain are activated during certain activities. And what Professor Kahneman was able to do was use that research, brain mapping, as well as much of the history of studies on human behavior, and apply it to the investment financial community. And the bottom line to what his story is that the human brain worked real well to survive us through evolution, but in its normal pattern of thinking does not make good investment decisions. So what we see is that the human brain, based upon the work that Professor Kahneman did, and he reports it in his book, which is entitled Thinking Fast and Slow.
Okay, Thinking Fast and Slow.
And what he says is that our brain tends to make decisions from the emotional side, even though we use data to support what we do. What we think is we're using data to support our decision. The truth is that most of the time the data is merely used to support our emotional decisions.
So sort of rationalizing our decisions.
Rationalizing, okay. And those emotional decisions did real well at keeping us alive. Fear, panic, concern, all of those things kept us alive when we were out in the field and had a lot of dangers to avoid. But when we use those emotions to make investment decisions, for the most part, they're not good decisions.
Okay. So how does the effect of the emotions on investing show up in our investment results?
It's a sad indictment of the investing public, Mike. Could you put up the first slide, please? What we see on that first slide is that investors are motivated by fear and greed. I call it greed and panic.
Okay.
What this slide says is that the far right bar totals up to 8.2%. What that means is that if you had invested in an index of 500 American companies, largest American companies, we call that the S&P 500 index fund. From 1993 through 2012, you would, if you purchased it in January of 93 and sold it in December of 12, you would have earned 8.2%. We call that a buy and hold methodology. Buy the stock market and hold on to it forever. Okay. But the American public, because of their behavioral way of making financial decisions, they use their emotions basically. They only earned half of that 8.2 or 4.3. Yeah, real indictment of the investing public. Really sad. Yeah. Even if the way to think about that is to say, you know, of course I earn more. I'm much better than that as an investor. But my friends and neighbors, they all earned 4.3, and that's really sad. In fact, if your friends and neighbors had done twice as good, they would have only earned the returns of the stock market. So it's very difficult to outperform a passive buy and hold of the marketplace.
Right. Well, and part of it, what it shows, I think, too, is that most people don't really understand investing very well. We don't have, let's just say, a lot of financial literacy.
Yes.
And the CPAs are trying to do some things. Other groups are trying to do things to try to help the public to get a little more informed. But even then, they need to understand these behavioral things that we're talking about, to understand a little bit about their own behavior and when they're making their decisions.
That's very true, Mike. The people who want to sell you something in the financial world are experts at appealing to our emotions. So when they say buy this investment because it's going to go up in value, buy it now while you still can, that is an appeal to our greed, and people respond. The human brain responds to that naturally. That is a natural human condition.
Right.
It's great that humans have emotions. It's not so great that they make investment decisions with those emotions.
Okay. Well, is there a time when investors aren't influenced by their emotions?
Probably not, for the most part. What we see is that there is a cycle of emotions that we can describe when people look at the marketplace. So on slide number 2, if you look on the far left, we start out with the market going up. People are optimistic about investments. They become excited. This is the time to buy. They're elated when they buy at the top of the market in pricing cycles. As the price goes down, we tend to get concerned and nervous, and we're thinking, boy, if this stock just comes back to what I paid for it, I'll sell it off and won't tell my wife that I made this bad choice. Pretty soon they're alarmed, and then they're frightened, really frightened. I call that panic. That's when they sell. It's just the evidence in the marketplace, and we'll look at some more of this in a little bit. Evidence in the marketplace is they buy at the peak when they feel good, and they sell at the bottom when they feel terrible and are panicking. Okay? And notice that the emotion starts back up as prices go back up, because prices always recover. The problem with the investing public is that when they see the prices going down, the reason they get concerned and nervous and then alarmed is because the human brain tends to project that falling price forever. The human brain is programmed to do that. But all the studies say that that's what happens when we look at a falling price. So we sell out, protect our principal before it goes to zero.
Yeah, so most of us think that tomorrow is going to be pretty much like today.
Yes.
And although maybe next year might be different, but at least tomorrow is going to be pretty much like today.
Yeah.
And so that's, that's why, again, that we tend to project that out, I think. Anyway, but then what we're saying is that, the old saying is that you want to buy low and sell high, right? But what we're saying our emotions are leading us to do is just the opposite.
The opposite. We're buying high and selling low.
Right. Okay. Now, most people think that investing is about picking stocks and timing. I mean, that's sort of the tradition, and certainly that's what we're sold, if you will. So, is this the time to buy? Is this the time to sell? Here's 10 hot stocks for today, or here's 10 stocks that you want to unload this year. These are the headlines that you see on the magazines and even some financial newspapers.
Yes.
So what do you think about that?
Well, timing the market, no one has been able to time the market successfully. All of the professional investment managers are saying, I don't time the market. We don't think anybody else can time the market either. However, they all are doing that when they pick stocks and time the trades. They're saying, buy this stock now, sell that stock now. Mm-hmm. So they're picking the stock and timing the trades. Mm-hmm. The problem is that the market is a dangerous place to time your trades. First of all, nobody knows the future, so it's impossible to know what tomorrow's prices, the next price, let alone tomorrow's prices are going to be. And the third chart, if you'd put the third chart up on the screen, shows the performance of the S&P 500 index from 1970 through 2012. That 33-year time frame is the far left bar. If we'd invested in the S&P during that time frame, we'd have earned 9.94% per year, mm-hmm. and that would have compounded our dollar to be worth $58,769. Our $1,000 to be worth $58,700.
Okay.
However, let's say during that time frame, you woke up one morning and said, gee, I think I'll just sell out of the market first thing this morning and get back in tomorrow morning. And it turned out that that day was the largest return gain in the market during that whole time frame. Best trading day for that 40-year time frame. Your account would have dropped from 58.7 to 52.7, about 10% almost.
Yeah.
Okay? That's a significantly expensive day mm-hmm. for just one day of trading. Mm-hmm. Let's say you were out for the whole week, 5 trading days, and that week was the highest gain return in the marketplace over that 40-year time frame. Now your market value would have dropped from 58,000 to 38,000. That's a significant loss in principal.
Yeah.
Okay? And somewhere between 15 and 25 days, you've really lost your retirement account. This is serious loss in market. So to time the market means that you're scared and your human brain is working normally, but building a discipline knowing that the markets have always recovered. Every time it went down, it went back up and grew beyond that. Mm-hmm. It takes discipline to hold on through those market cycles.
Okay.
We had the largest amount of money leave the market in the last recession. So in 2000, 2002, the markets went down about 47%, and we had in that time frame the largest amount of money in history left the equity market. In 2008 through 2009, the market went down close to 55%. And again, we set a record for the amount of money that left the market. So that money left after the peak, on the way down or at the valley of pricing, which means people allowed their emotions to produce panic and fear and they sold out at the worst time, at the bottom of the market. They're buying high and selling low. That doesn't work long term.
Okay, so maybe what we should look, I think we've got a few more details that we can look at about what happened after the Great Recession in our last slide here.
Yeah, on the last slide, if we can have the fourth slide up. This is a study that was produced last year in the Financial Analyst Journal by some very serious academician researchers. This study produced an awful lot of conversation in the investment industry as to why, how, and why it happened. Look at the left-hand side of the chart, and what it says is that in 1959, that bar represents about 50+% of the public were invested in the stock market. By 1968, that had grown to over 65% of the public were invested in the stock market. However, it changes over time based upon market movement, but currently the key to this, the surprising result of this study that's under so much scrutiny today is that far right bar, which says in 2012, only 37% of the public are invested in equities. That's the lowest since recorded, we started recording these numbers, okay, in 1959. That is a representation of the investing public investing high, and when the markets collapse, they get out. The last recession, I said earlier, went down 2008, 2009. Market went down almost 57%. That's a serious loss of principal.
Right.
Okay. However, had you held on, it would have recovered. But the investing public did not hold on.
No.
This study shows that not only did they get out of the market in 2008 and 2009, they stayed out of the market. By 2012, only 37% of the public were invested in equities. That means 63% of the public did not participate in the market recovery. So we are working hard, 8 to 5 years after year, year after year, and putting our earnings away into an investment portfolio and not getting the advantage of the returns in the marketplace because our brain causes fear. Our brain looks at the returns in the marketplace, projects them out forever, and as markets start to fall, that projection looks like zero instead of huge gains. So we buy on the way up and sell on the way down or at the bottom. And in this example, a huge percentage of the investing public has not participated in the recent market returns. Those returns have recovered all of the losses from that 57% loss in 2008 and 2009, returned those dollars to the peak and added 60 cents of profit to it. So we've had 160% return in the marketplace during that time frame. And the biggest percentage of investors are not participating in that.
Right.
They're scared.
Right.
Their emotions are causing them to pull out of the market and not invest.
And so what's happened, and for an awful lot of these people, I mean, this reflection on our society is, because a lot of these people are getting in the spot ready to retire and so forth.
Yes.
And now they've had the retirement fund basically decimated, and and again, they elected to pull out and not have that fund rebuild during this time.
Yes.
Now, so we have maybe about 8 minutes from here, Craig.
Okay.
So there are a few things, though. Well, one is, as I pointed out, there are a lot of things I think that sort of drive these beliefs that we have and the emotional response that we have. and one is, I guess you and I have talked about this before because we deal in this area, and that is, in a sense, buying and holding, in particular when we're talking about, a broad uh, range of stocks that you're doing this, and actually usually not even choosing stocks, or you're doing it through funds.
Yes.
That doesn't sound very sexy. And
It doesn't make the front page of the Wall Street Journal.
Right, right. And
yeah.
we talk about, again, emotions, and so it's, what makes your blood boil, if you will, what makes you get excited? Is it going to be, we recommend that you hold, a blended fund or blend of funds, if you will, that represents the world stock market, and that you just sit on this, and basically you not even read the news or even look at it as far as making investment decisions, and you're just going to sit on this thing. Or, again, what are the 10 hot stocks for this year, and what are the what are 10 that you should unload, and and should you get in now or should you get out?
Yeah.
That just doesn't sound very sexy. As
a buy and hold methodology.
For the buy and hold as compared to these other things. And also, again, I mean, as far as the publishers are concerned, you're not going to sell many magazines preaching, the buy and hold. You're not going to have very much exciting to put on the front page of your magazine.
Yeah. After you've said that, what do you say the next month in your magazine?
Yeah.
Buy and hold the marketplace. Never sell it. That kind of stops your magazine, because next month, what are you going to? Can't say that more than once.
Right. So so again, we've got the whole media that's sort of promoting this excitement and movement of people to do things related to their investment portfolio, when maybe the thing to do is just sit tight.
Wall Street is very good at appealing to your emotions as a human being. It is great that we are humans and have emotions, but it's not so great when we use those emotions to make investment decisions. The evidence in the marketplace is that when we make investment choices without discipline otherwise, we tend to depend on our emotions. And that emotional decision causes us to buy on the way up, and the evidence is that we buy on the way up and sell after the peak on the way down or at the valley. And that's buying high and selling low. It just is a real sad indictment of the investing public that occurs.
So, Craig, one thing that's happened, you and I know, over the last several years, is that there's been a promotion of the idea that people should have fixed annuities as part of their investment profile. Mm-hmm. And so they have some sort of security, know that there's going to be something there. I know that you've got some strong feelings about that.
Yeah.
Maybe I'll let you just comment for just a moment.
I got my insurance license in 1976, and I think I've exchanged 3 or 4 annuities, from expensive annuities to inexpensive annuities, but I've never sold a new annuity to a client. And the reason is that annuities are a feel-good. They look good on paper. They feel good when we buy them. They feel safe. The problem is that they for the most part, underperform what you think they're going to earn, and dramatically underperform what we can produce in a good diversified portfolio. So I look at annuities and I say, this is an example of how to sell a product. Annuity is a savings account at an insurance company, and it's got guarantees of principal, it's got guarantees of income. All of those sound so good. The problem is that we can exceed what those annuities pay in a well-diversified portfolio without buying annuities. And while put some numbers on it, in today's marketplace, the annuities are going to be earning some 2 or 3%, 4% at the most. Our portfolios, well, over the past 5 years, they've earned 160%. So,
Well, but that's an unusual period because it
Yeah.
involved market recovery. Nonetheless, people need to understand is that they hate taking risk in a sense, but when you get these higher returns, it's because you're being paid for taking that risk.
yeah,
And that's part of the reason
the
why.
way I say that to clients is that if you're being offered an investment that pays 10% when the market only pays 5, a good, safe, conservative bond only pays, when that bond pays 5, and someone's telling you they can pay you 10% in the same time frame, there's a significant amount of risk, increase in risk to that 10% yield. The 5% is very safe. The 10% becomes very, very risky in a 5% world.
Mhm. But you have what I guess we would call a risk premium. So in other words, and it's sort of the difference of what you get from investing in equities as opposed to the bonds, for example.
Yes.
Okay. So we only have about a minute left.
Okay.
How does working with a fee-only financial planner help?
Well, fee-only financial planner means that we work for the client pays us, it's our only source of income. So we're on the same side of the table as the client, in contrast to a commission salesperson, which is selling a product, working for the large warehouse. And while I encourage those people to sell lots of securities, I think that's a great idea. My clients are have great peace of mind knowing that I have a fiduciary responsibility for that client's well-being, financial well-being, and I am always going to be making recommendations that fit that client's needs because that's my job.
Yeah. So in a sense, though, what I think the role of the fee-only financial planner is to say, don't do that when the client is basically like, when they're in that panic mode when we see the
Three best words we can say. Don't do that.
Okay, folks. Well, we're basically out of time. I hope that we've given you some things to think about and think about maybe getting some support from somebody like Craig. We'll see you next time on Financial Insider Weekly.